Hey everybody, Steve here with IBC Global. Hope your day is off to a fantastic start. So in the video you're about to see, this is an actual presentation that I had put together for an existing client. She primarily uses her policy for real estate. She's actually in the process of taking out another policy on top of the one you'll see in this video. But in this video, you will see a number of options presented, really as she refined her decision-making process. This is the process we took her through, we would take everyone through as far as seeing what different options exist, how to maximize the cash value. Then once I've got that asset maximized, what are the next steps? Using the money actually for real estate. So the focus here was how to maximize the cash value and flexibility. And then we did spend a lot of time going over how to use it with direct policy loans, cash value collateral loans, and made a decision on the best option. But please enjoy. If you have any questions, feel free to reach out anytime, and we'll talk to you soon.
Happy Friday. I hope all is well with you and the family. So in this video, I am going to go through an overview of your Guardian policy and the approval with the new Guardian product. I'm going to touch on the old product, but I know I did that in the last video, and it seems like you've got a good grasp of the old versus the new. But mainly what I'm going to cover is the Guardian policy compared to different MassMutual policies that are available with their updated PUA fees, and really have a laser focus on the short-term cash value, long-term cash value, so you have a direct comparison. Then I'm also going to go through some bullet points just with respect to the PUA flexibility, how you can use the policy, just additional awareness. So you've got all the information up front and you can select the option that you are most comfortable with. So let's get on into it. Excuse me. So we've got a lot of numbers that I'm going to go through. I'm going to walk through the Excel spreadsheet and the detailed illustrations as well. But before I do that, before I just jump into the numbers, let's begin with just an overview here. So with Guardian, we've primarily been looking at the L95 policy. We wanted to get that in by the deadline, but we were unable to just with underwriting and such. So if we still did pursue Guardian, just based on the funding and everything that you're considering, I would still recommend the exact same product, the L95 policy. It's just the updated version, which I know we touched on a couple of bullet points before. Mainly, the main differences are the lower guaranteed rates, higher PUA fees. As we look at just a recap, the old version, the break-even point, when you were cash on cash, was the 4th year, whereas the new version, the break-even point, is now the 5th year. And I know the upfront cash value, just as you looked at it, you said, I don't know if that's really still going to work for me, particularly if you plan on using the money for real estate investing. I know your plan is to heavily utilize the cash value collateral loan, which is a great idea at the lower loan interest rate and such. But with that lesser upfront cash value, I 100% understand. So as we compare and contrast what is available with Guardian compared to MassMutual, I'm going to go through the pros and cons here. Here we go. So Guardian, all of their products, except for their 10-pay, but their L95 policy has a 3% guaranteed rate. The total dividend rate, however, is 5.65% for 2022. And Guardian does have the indexed feature available as well. I know we've looked at that before. I can certainly send you a video we have on that too. The main advantage to Guardian, in my opinion, one, they're one of the major mutual companies, but so is MassMutual. The big advantage is their PUA flexibility. With Guardian, you can easily commit to the minimum premium only, which comes out to a little over $25,000 per year with the term rider and such. But you can commit to the minimum and then just pour excess funds into PUAs 100% at your leisure. And that could be done through a mobile app, can be done through your laptop, tablet, whatever's most convenient. So that's their big advantage, where if you like the idea of saying, hey, aside from the first year, because I know you're starting off with a lump sum, hey, I had the lump sum, but aside from year one, if you said, I like the idea of just committing to a minimum premium only and then adding excess funds at my discretion as the money rolls in, that is really Guardian's sweet spot, and their product will really accommodate that type of funding pattern if you like that idea. So that is the advantage to Guardian with MassMutual as we look at these options. So I ran 3 different options with them. The first one was the one you had texted me about, their high early cash value product that has a guaranteed rate of 3%, same as Guardian's. Their total dividend interest rate, MassMutual as a company, 6%. Any whole life product you pick will have the same dividend rate. Here's the advantage to the high early cash value product. Strong early cash values. Long-term, not as much, but upfront, it is very cash rich. I've got 90% here. You're going to see the actual number is about 92% cash value in the first year. Meaning if you deposit $270,000, you'll see approximately $92,000 in cash value at the end of the first year. The beginning of the year, you might see between 89 and 90%. With respect to their PUA flexibility, it's not horrible, but it is not the same as Guardian's. With MassMutual, they've got a couple features with their different PUA riders with respect to their flexibility, but the way to make it most convenient for you as a policyholder is really if you're comfortable with a one-time per year payment adjustment, and it specifically falls on your policy anniversary date. So for example, if you started a policy in January, and that's your policy anniversary date when your premium is due, at that point in time, you can easily adjust the total payment you make without any underwriting at all. So making a one-time lump sum payment, you could break it up over 12 months or pay different frequency. I will add, if you're paying a frequency other than annual with MassMutual, their charges are a bit excessive in my opinion. They're much higher than most carriers, and I typically recommend annual, but I can go through the other frequencies like monthly payments and such with you as well. But back to this with the one-time per year payment adjustment, let's assume year 1, paid in $270K, year 2, things were a bit slower and you only paid in $100K. If you wanted to just add additional funds, let's say 6 months into year 2, you wanted to add, hey, I can throw the other 170 in now. Can I do that? The answer is yes. And there's ways to set the policy up where you can add funds at random, but it's typically, there's a 2-year window where we can do that. I can only do it 3 times per year. It's a bit complex, but I can definitely provide some info on it. Aside from that, if I wanted to throw funds in at random, MassMutual would require some type of medical underwriting and paperwork before they accept the money. Where they work very well is if you said, okay, I paid in $100,000 January of 2023 in the second year. I'm going to wait until year 3. At that point, I'll increase my payment back up to $270. I can even make up for lost time if I wanted to. But the big difference is with MassMutual, it's very easy to make the one-time per year payment adjustment, whereas Guardian, it is at leisure. So that's just a difference in their flexibility features. Their 10-pay product. So there's a couple ways to design it. I designed it for absolute maximum cash value, beefing up that internal rate of return as much as I could. Here's why I state that is when it's designed properly, you'll see strong early cash values. You'll see the strongest long-term performance among all MassMutual policies with this option. Here's the drawback. With respect to their PUA flexibility, it is extremely limited. It's very easy to decrease PUA payments, but it's hard to increase them unless you want to go through medical underwriting again. Now, there are ways to increase them without underwriting, which I can go through. It's a bit complicated. We'll have to track it. There's a 2- and 3-year window to be aware of. But basically, if I were to summarize and say, if you were to ask, okay, I'm interested in that 10-pay product, how do I make sure that I do everything properly for maximum cash value? Because once the money's in cash value, then I can just leverage the line of credit, the collateral loan for my real estate investments and such. I know that's your plan. So if you said, hey, with my funding, Steve, like the plan is to do $270K years 1 and 2, and then 180K, years 3 through 5. And after that, maybe I just pay the premium, maybe it's a reduced amount, maybe it's still 180, whatever it might be. If you knew with certainty, hey, I can follow that pattern, specifically year 3, when I go down to 180, I'm not going to want to or need to go back up to 270. Like, you don't really have much desire to bounce up and down. That's where the 10 pay can work quite well. Also, the terminology 10 pay means you can pay into it for a maximum of 10 years, which I think will work well because I know primarily we looked at 5 and 7 year funding periods, and you could go up to 10 years if you wanted to. After that, though, premiums can no longer be paid into the policy, just for full awareness there. Let's continue on here. I almost skipped over an important piece. The guaranteed rate with this product is at 2%, but again, the total dividend interest rate is at 6%. And I'll add, we can design this policy to have the same flexibility where you can adjust it one time per year. But what ends up happening is it increases the premium quite a bit, and it strips the policy of the strong upfront cash value performance. Long term is still decent, but it will retract to something that looks worse than kind of the main pain point you're experiencing now with the Guardian policy. So if we make the policy flexible with that one time per year payment adjustment, this is specific to the 10 pay, we'll have less cash value up front, and it will impact the IRR a bit. So that's why typically we design this without flexibility to juice the cash value. But it is a good option to be aware of. The last thing I'd want if I'm you is to find out this existed after the fact. But flexibility or lack of, that would be the big drawback with this product. And then the 15 pay, this is a nice middle of the road option. It's similar to the 10 pay with respect to the cash value performance and the internal rate of return. Guaranteed rates at 2.5%. Of course, the total dividends still identical. Here's the difference. Strong long-term performance, but with the PUA flexibility, you've got this guy where you can easily adjust payments one time per year. The minimum premium is higher than 10% on this one. It's not $27,000, it's $40,000 and change, but it functions almost as if it were $27,000 at 10%. And I'll walk through the illustration with you to show you how and why it does that. Basically, this product credits a percentage of the base premium to cash value immediately in the first year. So a lot of info there. The big difference, if I were to just summarize, is flexibility without going through all of the extra info. But I know the extra info is important. This way, you know exactly what you can do with each product. And I've enjoyed our discussions going into the weeds and really going through the bullet points of the products thus far. But overall difference: Guardian, very, very flexible, commit to the minimum, add more funds at leisure. Mass Mutual, not quite as flexible, but you will see stronger upfront cash value, particularly in the first year. So let's take a look at the comparison here. Why don't I start actually? Okay, so with the Mass Mutual options, which is the second tab, HECV, high early cash value product, whole life 15 pay product, and then whole life 10 pay product. So what we've got here, 270 years 1 and 2, and then 180 through year 5. We can continue to fund thereafter if we want to, but I just kept everything consistent with really what we've been looking at for the most part. And here you go, 270 in the first year, cash value right off the bat, 248 and change. So this will credit the strongest amount of cash value up front. If we were to look at the actual percentage, 248, 519 divided by 270. There we go. So almost a clean 92% right off the bat. Break even point, almost year 4, really between years 4 and 5, what's highlighted in yellow here. So the first year cash value is really the most attractive with this option. Year 1, 248, year 2, you're at 509, pretty much 510, and it gets stronger and stronger each year. With that said, when we compare it to the other options, so if we scroll our eyes to the right, here's what we'll notice. high yearly cash value is a nice option, but a lot of people elect against it only because when I look at it long term, it does lag compared to the other products. And there's not enough of a difference in the first year where someone says, okay, that is significant where I can really use the extra cash. But some do, like it is a good option. It's ultimately up to you. 15 pay, 270 in, 231, about 232 in cash value, breaking even, year 5. If I were to compare the year 10 mark, actually, let's not do that. The year 9 mark is where the 15 pay product overtakes the high yearly cash value product. Both the high yearly cash value and the 15 pay in these examples will allow you to make payment adjustments one time per year, every year on the anniversary date, no medical underwriting, very easy, as long as we still have that term rider attached, which I always monitor that for you and we go over during review meetings. But that's the key difference. As we look at it long term, so you don't pay anything in after year 5, which we easily can, there is a difference. So that 15 pay product does produce strong long-term values with the ability to adjust payments one time per year, every year on the anniversary date. That's the big advantage there. Now, progressing to the far right, the 10 pay policy option. This guy looks good. Upfront, just about $240,000 when 270 goes in. So it's not quite as strong as the high yearly cash value policy in the first year, really for the first 3 years. By year 4, though, in year 3, there's not much of a difference, but by year 4, just about breaking even, you're at 892, just about 893, whereas over here, you're at 893. And then year 5, with this 10 pay option, you are stronger. Now, the big drawback to this, not everyone selects it because of the lack of flexibility. That is the drawback. So you could easily follow this pattern here. However, if you want the flexibility to perhaps year 4, go back up to 200 or back to 270 or something like that, there's a good chance they'll come back with medical underwriting. There are ways to set it up too, to build in some flexibility, but it's not like what we've been used to discussing with Guardian. There is a big difference there. I cannot, with this particular design, do the one time per year payment adjustment. We can build that in, but I don't like it as much because it really impacts the upfront cash value and break even point, which I know is important. So as we look at this guy here, look at the year 20 mark, what do we notice? 2.195. Not much difference with the 10 pay, 2.135. There is a difference at $60,000, but at the same time, this is where I've got that flexibility. That's why I like that 15 pay option. But compared to this, there's a big difference there. Same company, same product, just with how the crediting works and such. And the guaranteed rates, typically what you'll find, the lower the guaranteed rate, the stronger the non-guaranteed performance, which is interesting when you look at the mechanics of life insurance policies and how that works. So let's progress on now to the comparison sheet. And then I'll wrap up with illustrations so you can see exactly where your money's going and such. So here, you've got the comparison. On the left, we've got the old Guardian product. So no, this is the one we originally wanted. Unfortunately is no longer available, just with the 7702 changes. The 270 in, the 239 in cash value, just about 240 right off the bat, versus the new option. So I did want to compare that because I know that was the main thing that you're kind of, that stuck out. So this way we can compare it side by side instead of having to reference old spreadsheets and such. New product with Guardian, 270 in, 225 to 226 in cash value, the difference. So that's a difference. It's about 14K, almost 15 really when I look at it there. No, I'm sorry, it's about 16K. I did my math backwards. Okay, so there is a big difference up front. Break even with the old one, you're positive year 4, new one, year 5. So long term, we know the new one produces stronger cash values based on the non-guaranteed dividends. Guarantees, that's not the case. But let's progress over to the right. 15-pay product. 231, about 232. So stronger than the new Guardian product. This is because of the lower PUA fees. With the old Guardian product, getting closer now. You're at 232 compared to about 239. Call it almost an $8,000 difference there. So there still is a difference. And then with that 10-pay product, which we give up a lot of flexibility with this, but it does get us back to where we were with this guy in the first year. Second year, not so much, right? I do see a difference. Year 5, 1.1 over here, 1.1, very similar, right? There are differences, obviously. As you look at all the new products, if we look at everything long-term, which by the way, all of this will change. I know we've talked about this before, but whenever we look at non-guaranteed illustrations, they're great to look at, but in reality, none of it ever comes true, or it's extremely rare that it comes true. The policy, the net internal rate of return, the actual performance over time with either of these companies, when it's well designed, will likely fall somewhere between that range, 3 to 5%, just to set expectations. That's what I would expect. Historically, they've done better, but dividends are much lower than where they've been historically. That's why I like that 3 to 5% range. Year 20, old, 1972. New Guardian, 2114. 15-pay product, check this out. 2135. Not much of a difference there. And even with the 10-pay product, there's not much of a difference. There is, but at the same time, with Mass, we've got the dividend interest rate of 6%, whereas Guardian, we've got a 5.65%, so slight edge to Mass Mutual right now. But again, they always go back and forth. A thing I like to say or inform everyone of is whenever you look at any of the major mutual companies, Mass, Guardian, New York Life, or Northwestern Mutual, they all have different dividend interest rates. If you look from top to bottom right now, Mass is at 6%, Northwestern Mutual is at 5%. However, when you look at their actual performance over time, I've always seen them go back and forth with each other. And when I examine independent policies, not comparisons that one company shows compared to another company, but independent policies, I've seen them go back and forth with each other in terms of net performance, which is why I don't like to really say, hey, based on the projections right now, one company looks better than another, because it almost never matters. But as I look at the comparison there, what is beneficial about this is the upfront cash value, because I know that is important to you as you look at everything. So let me wrap up with the detailed illustrations, and I'm just going to touch on these quick because I know we spent time on them before. Here's the old product with Guardian. There's our minimum premium, $24,000 and change, because the carrier will allow us to 10x that base premium in PUAs. There we go, for a total of $270. Old product had a high death benefit. New one, identical premium. Not going to walk through the values just because they're the same thing from the Excel spreadsheet, but identical premium, identical PUA, everything's the same here, except the initial death benefit is lower with the new products, lower guaranteed rates. I need less death benefit for the same $270,000 MEC limit, which is interesting. But same premium, same design. When we look at policy design, everything is apples to apples, which is exactly what we want. Then we've got the higherly cash value product. Where is your money going? This is the big question. Mass Mutual allows a maximum of 10x the base premium to be paid in a total payment per year. There's your base premium, $27,000. We've attached LISR, also AILR. Here we go. Total of $270. Values match the Excel spreadsheet. There's your cash value. The one thing that I always like to validate on illustrations, MEC limit, solving for the minimum death benefit possible. to be able to obtain that $270,000 MEC limit. And then same thing, actually with a 10 pay, this is a little different with the riders we use here. $27,000, 10% minimum premium, renewable term rider, which is actually a level premium right now for the first 10 years. That's the term insurance rider. Quick refresher on that. Cheap way to raise the death benefit, which is a cheap, if you don't like the word cheap, cost-effective way to raise the MEC limit on a policy. And then just plowing everything else into PUAs. There we go. You'll see the MEC limit on the bottom right-hand corner as well. Be right around that same 270, 272 to be precise. And then the 15 pay. So we'll conclude with this because the premium is a bit higher, which when we add LISR, which without getting too technical, is what gives one the flexibility to adjust payments one time per year without any medical underwriting specific to Mass Mutual. Here's the difference. Base premium, $41,000 and change, and that's as low as I could drive it in this particular example. So that's high. Where I came up with that, and I'm not where I came up with it, but where it doesn't make a huge difference, because you likely noticed when we went through the cash values, they're very comparable to what that L95 policy is that had a $27,000 base premium. What happens with this? Just about 25% of the premium, we can actually see in this column right here, of that 41,325, this number, 11,637, shows up in cash value right off the bat in the first year. So granted, we don't have a $27,000 base premium, the percentage of money that shows up in cash value or does not show up in cash value in the first year is very close to 27,000. To conclude that point, what I like to do here is take the base, 41,325.7, minus the amount that does show up in cash value, 11,637, 29,688. That is the dollar amount that is not showing up in cash value from the base premium in the first year. And then beginning the second year, the majority of that entire base premium comes back to work for me, or back to work for you in this case. And how you can see that is when I look at the cash value growth, it grows from 230 to about 485 when you've paid in 270. So you don't get quite all of it back, but you are getting the majority, and then each year it gets better and better. No, that's a lot of info. If you have any questions on this, just with respect to the products and how to maximize the cash value, let me know. We can certainly plug this in with any of the cash value collateral loan models we've looked at before as well. But just to recap this, the Mass Mutual products do offer greater upfront cash value, particularly in the first year, than the new Guardian product. The main factor that would refine my decision-making process, if I'm you, just from our conversations thus far, is that PUA flexibility. If you still like the idea of having maximum flexibility, just to go back to the Guardian example, here's exactly how I progress through this from a thought pattern to conclude this, is to say, okay, if I want to pump in $270,000 per year, the first year I've got $225,000. Where if I plan on accessing this, I might not need all of it, but if I do, that hurts. Does the flexibility I have beyond the first year make it more attractive to me? Meaning, am I still more comfortable with Guardian having the ability to commit to the minimum premium and the term rider only, and then adding additional funds at my discretion? Or would I rather give up some flexibility in order to get more cash value upfront so I can then put it to work in my real estate investments and such? So I hope that this was helpful. Reach out, please, if you have any questions. We can certainly connect over another Zoom call, phone call, whatever is most convenient for you. And I will talk to you soon. Have a great weekend if I don't talk to you before then. Thank you.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.